Welcome to episode 85 of Accessible Finance for Retirement. I'm Eric Johns.
And I'm Rachel Johns.
Let's dive in.
This is our third and final episode in our Roth miniseries. And this one's going to dive into some advanced Roth strategies and how to maximize the tax-free growth that you have available. Mm-hmm. All right. So, Eric, I want to start with a backdoor Roth. It's something that people may have heard of, may not have heard of. But what is it? How do you do it? Why is it good?
It's just the name for a Roth conversion that you're planning to do with some regularity, really. But it doesn't even have to be that. It's just a Roth conversion. That's it. That's what a backdoor Roth is.
But then why wouldn't they not just call it a Roth conversion?
Because the front door Roth conversion, or contribution rather, has limits. If you make too much money in your income, right, on line 11 of your return, then that's just your AGI, sorry. But if you make too much income, they won't let you contribute through the front door. So but for whatever reason, this has been allowed since 2016, I believe it was. Mm-hmm. And people weren't quite sure if it was legitimate or not. But time and time again, Congress has had the opportunity to close the loophole, and they have neglected to do so continuously. And there are now rulings that have essentially legitimized the practice.
That Congress members are likely the ones to
they're using it. For sure that's correct.
So if you want to contribute to a Roth, but you exceed the income limits, correct, this is your backdoor. Yeah,
this is the option that's available to you, right? So there are a couple things to look out for, right? The pro rata and aggregation rules you'll often hear about, and we'll talk about sometimes. Mm-hmm. What that means is you can convert your IRA balances, but when you do so, you are treated as if you're converting a portion of your total IRA balances, right? So they're going to aggregate or put together all of your IRAs. Does that make sense? So if you have like a SEP IRA, a simple IRA, contributory IRA, a rollover IRA, those are all going to be added together.
Okay. All right. So let's say that I want to pursue this strategy. Give me a brief step-by-step, like what it looks like start to finish, right? So I have money. I want to get it into a Roth. I can't go directly into the Roth because I exceed the income limits, right?
Right.
So where do I have to put the money first?
So I'm going to make a direct contribution to a contributory IRA or just a traditional IRA at a brokerage house. So I might transfer $7,000 from my our community property account at Schwab to my individual IRA,
because
right?
It has to be
a contributory IRA, right? Yeah. So I'm just taking money from my taxable account, putting it into my contributory IRA account,
so
right?
Your traditional account.
Correct. Traditional contributory IRA. And then I'm just going to press move money from the contributory IRA, right? Schwab calls it move money. It could be whatever your custodian calls it, right? Yeah. You're just transferring funds. You're just making a funds transfer, electronic funds transfer from your traditional IRA to your Roth IRA.
All right, so money goes from my taxable account into a traditional. Yep. Then I convert that from the traditional into the
Roth. I'm really just moving it, right? So I'm just moving it.
From left to right.
Correct. Nothing's happened from a taxation standpoint yet, although when you do the money movement from the contributory or traditional to the Roth, they will typically ask you to classify this. They will say, is this a distribution or is this usually it's just a drop down. It'll say conversion because, algorithms and digitization of finance is smart enough now to realize what you're doing. And so you just check the little, you just put the conversion box on there.
Surely that can't
so that they know where to put it on your 1099. Your 1099.
Okay, but surely that can't be the whole thing, right? So like I contributed to my traditional, converted from traditional to Roth. Mm-hmm. Now what?
Now I choose my investments in my Roth and wait for my tax filing deadline and then add Form 8606 to my tax return. So
seems pretty straightforward.
It is. It really is. And 8606, Free Tax USA or TurboTax or any of those softwares will, have those forms and they'll ask you questions that'll make the entry a little easier. I will say that form adds a little bit of, it's just tricky to fill it out correctly. You kind of want to, you could probably, I don't want to say you can Google it, but you could probably figure out what a correct 8606 should look like for like a $7,000 backdoor Roth. I'm sure that's available online. Mm-hmm. And then you just want to make sure that the output that they produce for you, if you're self-preparing, is similar to that, right? You want to make sure that it looks right. But what's basically happening is you're making a non-deductible contribution, and then that's going to make you have, or that's going to substantiate your basis in your IRA. So they'll say, what's your basis of your contributory IRA? Total IRA basis is what they'll call it, and you'll just write 7,000, right? And then it'll say total IRA balance, and it'll also be 7,000. So then the taxability there is going to be 0. But the idea is you're not taking the deduction on Schedule 1 for your IRA contribution.
Okay. So then question.
Sorry,
Let's
lots of
say
words.
I have my money. I've taken it from my bank account and I put it into my traditional.
Okay.
Right. Life got really crazy. Life got really hectic. I did not convert it into a Roth for 3 months.
Right.
Is that a problem? Is it complicated? Does that create any challenges?
Not if you're still before the end of the calendar year. So with a Roth contribution through the front door, you have until your unextended tax filing deadline, so usually April 15th. For a Roth conversion, it has to be done by the end of the tax year, which is December 31st. So you have to have done it then. But if you make the contribution, anytime October or sooner, really, September or sooner, you should be good to go.
Perfect. So yes, you may have heard murmurings of, talk of getting rid of the backdoor strategy. There have been 0 movements to make that happen.
Every time that they do a new Secure Act or Secure Act 2.0, everybody thinks, any kind of revisions of the tax code. Honestly, we think that it would be there, like that they would close this backdoor, this loophole, because why would you have a limit to contributions if you're simply going to allow a way around that limit regularly? Everyone has the same option around the limit. I guess it gives, us and tax planners more to do. That's kind of nice of them. Thanks.
I imagine it's an intimidating thing to take on, though, because it's yet another step that you have to take where you're having to file the correct form and do the things the correct way. And
sure.
So the intimidation factor may alone be enough to disincentivize a number of people from pursuing this very valuable strategy.
Right. And if we're speculating on why the government does what they do, we'll be here a while.
Yeah.
But also, part of what they're doing, right, is they want conversions to be legal and permissible, because when you do a conversion, you're paying the tax, right? So
Sure.
Gaining additional tax revenue is always going to be there for them. They want tax revenue today at the expense of tax revenue tomorrow, because they're not in office tomorrow. They're there now.
Yeah, that's fair. Okay, so we talked about the backdoor Roth. There's also something termed a mega backdoor Roth, which sounds fake.
Sounds fake.
Sounds fake.
Right.
What is it?
This refers to the strategy. All right, I'm trying to think of the best way to start. I think the best way to start is your 401k plan has to allow it. Not many do. Okay, so your 401k plan has to allow for after-tax contributions. Okay, so all the 401ks are going to allow. I shouldn't say all. I'm sure there's some exceptions. Most of the 401k, the vast majority of the 401k programs are going to allow you to defer up to the annual maximum, which in 2025 is $23,500. Okay, and then more if you're over, if you're 50 or older. So I can defer, right? I'm 39. I can defer my $23,500, and then my employer can match some percentage, and then there's an aggregate total contribution threshold of $70,000 in tax year 2025. Okay. So some plans allow for you to make after-tax contributions to your 401k after you've already done the 23.5, right? And then so you can essentially do your after-tax contributions up to $70,000, but you have to subtract out what you've deferred, so your 23.5 usually, and then what your employer has matched, right? You wouldn't want to contribute more so that your employer doesn't have any room to match you. That would be really bad. You would be leaving free money on the table.
If I contribute $70,000, then they're like,
right.
You're already filled up. We can't give you any dollars.
Bucket's already full. Our hands are tied, guy.
Okay, yeah, exactly.
So you can't do that. But so the idea is you can make your after-tax contributions, right? Once you've already filled up your tax deferred contributions, and then these after-tax contributions, your 401k plan has to allow for after-tax contributions, and then they have to allow for either in-plan conversions, right? In-plan conversions or in-plan in-service distributions, right? So you either need to be able to convert your after-tax contributions to your after-tax 401k to a Roth 401k in your plan. And again, some plans allow it, most don't, but some do. Or they have to allow for in-service distributions, which means usually you have to separate from service, like you have to be fired or quit, before you can take money out of before you can really access your 401k funds in any meaningful way, before you can transfer them to an IRA and do what you want with them. However, some plans, some 401k documents will allow you to withdraw from your 401k while you're still working there and an active employee in the company, right? So I can make these
very atypical.
Correct. But it allows for it allows for some pretty neat planning opportunities, right? So you want to be able to think about it if you're at one of the companies that's going to allow this.
If you're not sure if you're at one of the companies that would allow this, HR is your best bet.
Correct. Talk to HR. Yeah. You can read the summary plan description, which is pretty long usually and kind of tedious.
Yeah, I go to HR.
Yeah, probably just ask.
Yeah, just go to HR.
Right.
But the mega backdoor essentially allows you to do the backdoor without the limitation on the amount.
Correct. Right. So backdoor Roth is typically thought of as the annual contribution to the Roth. Mm-hmm. So you take the annual contribution limit, which applies to both Roth and traditional IRAs, right? And then instead of making a traditional IRA contribution, you're going to make it's still a traditional IRA contribution, but it's not deductible on your return because you've exceeded the income phase outs.
Right.
I know this is all very ridiculous sounding.
That's why this is our deep dive.
Right. But so the idea though is what you can do with this mega backdoor Roth is it enables you to, first you can go through the front door Roth, but you're probably not able to, especially if you're able to defer the 23.5 plus the additional.
To do that, your income.
Yeah, your income's going to knock you out of all of these things, right?
Yeah.
So you can't really do the front door Roth. You can do the back door. So you can do your $7,000 non-deductible contribution. You can make that conversion, but then also you can contribute to your plan documents. Remember the employer match plus your deferral, subtract that from the annual maximum. You can then make that as a non-deductible contribution to your 401k. And then you can either roll that out, the piece that's the piece that is your basis, right? So the non-deductible portion of your contributions, not your deferrals, because that's to your pre-tax account, right? But it's the non-deductible portion. You're going to roll that out either to your own Roth IRA. That's called an in-plan distribution, right? Or you can have an in-plan conversion where you convert it from a non-deductible portion of your 401k to a Roth 401k.
If this is feeling
it's a lot. It really is.
It is.
It's awesome. It's great.
I was going to say,
I love it.
There are a handful of people in this world that love this stuff.
Put me in, coach.
He's one of them. It's important, even if you don't know all of the details and nuances of it, that just to know that this is an option and to know what qualifies you to be able to take advantage of this option. If you find that you are not at a workplace that allows for this, then that's okay. You let go of everything you've heard of backdoor Roths for now. So we have discussed in the last episode the importance of record keeping and making sure that you are keeping track of whether you're doing conversion or contribution and how much and what dates. And this still holds true. Now, Eric, in addition to backdoors and mega backdoors, there's also been a lot of talk lately. It's all over social media now, as everyone has determined that they are now financial experts. I'm
glad I missed it.
Right? You miss all the things. But it's all over social media now, like how to game the system in your estate planning, right? And one of the things that's talked about a lot is Roth accounts and how they can assist with estate planning.
Okay.
So can you help bridge those two things that we've just talked about Roths, we've talked about estate planning previously. What role do Roth accounts play in estate planning?
So we're typically talking about the way to think about it, right, is the funds are either going to be usually in a tax deferred account or a tax free account. And so the cost of the tax deferred account is going to be the taxation of those funds either to you or upon your estate to your heirs. So if you have heirs that are doctors, right, lawyers, whatever, they're in very high brackets. Yeah. Maybe they're in the 37% tax bracket, but you yourself are retired and you're just collecting your dividends and Social Security and everything else. And so you're in the 22% bracket or 24% bracket. There's a difference there that you could, fill your 22, fill your 24, maybe even go further, maybe fill the 32, because still, if you fill the 32 bracket, every dollar that you're converting in the 32% bracket, you're still saving 5% as a difference in taxation, right? For your heirs, because they don't have to pay that tax at 37% rate.
Now, to be clear, in order to be aware of these decision points and to make these decision points, you have to be having very open and candid conversations with your
That's true.
heirs about money and finances. You have to be aware of what their tax brackets are. You may not feel comfortable doing that or be in the know on where they are. So some of these conversations can be quite delicate. It's important to start having conversations about estate planning and things like that with your kids, because, and we've talked about this in previous episodes, we can't know what's going to happen when, and you certainly don't want to leave your heirs in
a rough spot,
really unfortunate position. So do have those conversations. But you may not know exactly that they're in the 37, so you may not feel comfortable pushing all the way up to the 32. But you're pretty comfortable they're somewhere in the 30s, so you might be all right pushing up to the 28.
And again, it doesn't have to be in 1 year.
Correct.
So you can come up with a medium-term plan that says over the next 10 years, we're going to fill up the 22 and 24 because we're pretty sure that our heirs are going to be in the 37%, right? You can even do some creative planning where you leave the tax-deferred assets to those heirs that are not in the 37%. Maybe you have one son or daughter that's a teacher and one son or daughter that's, a doctor, right? Or a surgeon or whatever is going to insert very high paying profession here.
A wide variance in earning.
Yeah. Then you might consider, consulting with, a state attorney or a planner that's going to tell you, hey, look, the after-tax equivalent of this tax-deferred balance in the hands of your 22% bracket heir is, X. And then the Roth balance, you can tell, it's just going to be what it is, right? Because you've already paid the taxes on those dollars. But the point is here, the calculus that you should be doing, or the way to think about it is, instead of playing tax arbitrage with your current self versus future self in terms of tax brackets, now you're playing it current self, future self plus heirs.
Yeah.
Does that make sense? Particularly if leaving a legacy to your heirs is part of your, if you're concerned with that, if you want to.
Right. Your plan.
Exactly.
Yeah.
Some people don't want that, and that's okay.
Exactly. And this is yet another thing to think about. Like, is this something that interests me? Is this something relevant for my planning purposes?
Right.
The answer might be no.
Absolutely.
All right. So then, Eric, the final topic for today is about tax diversification in retirement and its purpose. Because we've had people write into the podcast talking about how they have only tax deferred retirement plans, and now they're wondering, like, why do they need a Roth? Or they have people who are in tax deferred plans going, oh gosh, like, now I'm scared I don't have a Roth. So how does tax diversification play out in retirement? Why is it important? And how does the Roth account feed into that?
Great question. So long and short of it, we're trying to be super intentional about the rates that we're paying taxes. Mm-hmm. If we see that we are in an artificially higher or lower, anomalously, I guess, higher or lower bracket than we think we're going to be in the future, we want to draw on the accounts that are going to, bridge that gap. So if we think we're artificially high this year, right, or we're marginally higher than we would be in the future, we might want to just pull from our Roth, because we don't really want to pay any more taxes right now in the higher accounts. However, there might be a year where, Social Security hasn't kicked in yet. We retired last year. Maybe now we want to either convert funds, so we want to pay more in taxes, or we're just happy we need to spend the money. Yeah. We need to get money to spend, go eat sushi from somewhere. Yeah. So you just pull it out of the tax deferred account. Yeah. Right? So, because you're happy to realize the taxation in the 22% bracket this year, so that you don't have to pay it in the 32% later, right?
And as a reminder, the three buckets that we're talking about are the taxable, the tax-free, and the tax-deferred. And the more, funding all three of those buckets, having money in all three of those buckets allows for maximum flexibility to meet the needs of your life as it changes. Mm-hmm. The reality is that the tax situation you find yourself in while you're married versus while you're a widow is going to be very, very different.
Well, that's true, unfortunately.
Yeah. And then depending upon your age or when you've had kids, if you go from having dependents to not having dependents, if you go from, working to not working, if you own your own business, and so income is just
highly variable.
Yes. So there's so many reasons why the blanket assumption that people, it's so outdated, but it was the, very popular mindset of when you retire, your taxes go down. And that may not always be the case. So being able to have maximum flexibility to meet the needs of your current tax situation year to year is incredibly important.
It's also worth noting that you or your heirs will pay tax on your tax deferred balances. The government's going to get their hands on that money.
Regardless.
So that's when we talk about we want to pay taxes when they are the lowest rate, because there's no option to never pay taxes. I understand that like deferring it, some people just think, oh, I'll defer it forever and that can be my kid's problem. Sure, but just know that like they are paying taxes. Like you didn't like beat the government. You know what I mean? Like you didn't hide the money. They're still getting access to it.
So that really goes down to how you view your legacy desires. And it may be like, I worked hard for this money. I don't want to pay taxes in it. And then whatever's left over, like they can go ahead and pay taxes. If that is what you want, totally fine. We just impress upon clients and people that we speak to that you want to be fully aware of the decisions you're making before you're making them.
Right.
And so oftentimes, we'll have clients who are very concerned with like, I worked hard for this money. I want as much as possible to remain in the family. And so it's really appealing to be able to pay taxes at the lowest rate, whether it's now from me or later from my kids.
Correct. Most of what we're solving for is the highest after-tax balance in either for yourself, for your spending, or for your heirs, right? Like we're looking for the most money that we can get from what you have now in after-tax dollars to you. Correct. Because all that matters is the after-tax dollars is going to hit your account that you can spend, right? That's what everyone really wants.
Yeah. So then to conclude our 3-part series on Roths, I think it's important to just kind of review some of the key benefits about like incorporating Roths into your retirement planning. So the first is that it's tax-free growth, and the withdrawals provide protection against future tax rate increases. The second thing is that they don't have RMDs, so it allows you to have a bit more control over your retirement income.
That's true.
It can be a valuable estate planning tool to create tax-free inheritance potentials for your heirs, particularly, as we said, those who are in high brackets. It can allow for a significant reduction of your lifetime tax burden. And then there are advanced techniques that we talked about today, like the backdoor and mega backdoor Roth strategies that can expand the tax-free savings capacity if on surface you don't qualify for participating in the Roth. All right, Eric, anything else that you want to say about Roths?
Just that they provide a fantastic tool for planning purposes. They allow us, particularly Roth conversions, allow us to be very intentional about when we pay taxes, and that's what we're after. We want to be very intentional about when we pay taxes, and we want to do so at the lowest marginal effective rate. Again, that could be shortened to marginal rate if you don't have to think about things like IRMA or Social Security taxation or net investment income tax. Those are typically the 3 things. There are others, child tax credits and potential like AOTC, American Opportunity Tax Credit, Lifetime Learning Credit. Point is, we're just thinking about marginal brackets, right? We want, when are we going to be the lowest? Have we filled the lowest brackets relative to the future? So like it actually might make a lot of sense to pay taxes even in a marginal bracket as high as 32 if we're certain that we're going to be in a 37% later. Yeah. Then every dollar that we didn't allow to be taxed at 32%, we're now going to be taxed at 37% later.
Exactly.
Right?
We're
So
paying an extra 5 cents.
So correct. It's all about your individual situation and then being very intentional and deliberate about when you are going to pay your taxes, because you're going to pay them, unfortunately. All right. It'd be great if you didn't have to, but you're going to have to.
Yeah. And so it's a lot of information that we've shared over 3 episodes. And if these are strategies that you're looking to implement, if it's something that you don't feel comfortable doing solo and you're looking to work with a financial advisor, not all financial advisors are created equally, and even those with the same designations may have different interests or different knowledge bases. So it's really important as you're going and shopping around and trying to find who to work with, that you're finding someone who specializes in or really knows a lot about retirement tax planning specifically. So Any other points? No?
No.
All right. If you have any specific questions, please don't hesitate to reach out to podcast@equilibriumfp.com.
Thanks, guys.
Till next time.